Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel. Several subscribers asked me to make an updated stock analysis video about Tesla stock. Just right before making this video, Tesla announced their latest Q1 2021 earnings and deliveries. Many people ask, is Tesla stock still a buy right now? And is Tesla stock currently overvalued, fairly valued, or undervalued right now? And what are Tesla's long-term growth prospects and what are the risks? So in this video, I'm going to cover these topics to answer these questions. First, I'm going to talk about what are the key takeaways from the most recent Tesla earnings. Second, I'm going to talk about what are Tesla's 3 long-term growth catalysts. Third, I'm going to talk about what are Tesla's 3 main risks we should all consider. Then I will talk about what is Tesla's current intrinsic value. Is Tesla still overvalued, fairly valued, or undervalued right now? Then by the end of the video, I'm going to talk about, am I going to buy more Tesla stock? If you like this video, hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and commentary videos every week that will help you become a great investor. Now let's start. So what are the key takeaways from the most recent Tesla earnings release? If you look at this here, you can see that Tesla's total deliveries already reached 596,028 in the last 4 quarters from Q2 2020 to Q1 2021. You may already notice in 2020, Tesla's total deliveries were just slightly below 500,000 vehicles. Model 3 and Model Y are still the most important revenue driver growth for Tesla right now, not Model S and Model X. If you look here, you can see that in Q1 2021, Tesla delivered 182,780 Model 3 and Ys, up 140% year over year. The first quarter is usually the slowest with the lowest growth rate, but this shows that Tesla actually achieved very high growth rate, which is very impressive. Elon Musk said this in the earnings call. Model 3 became the best-selling midsize premium sedan in the world. In fact, I should say the best-selling luxury sedan of any kind in the world. The BMW 3 Series was for the longest time the best-selling premium sedan and has been exceeded by the Tesla Model 3. Model S and Model X deliveries were only 2030. Tesla is still fixing production issues for its latest new Tesla Model S refresh. Elon Musk said this, but we do expect to ramp Model S production and start delivering them probably next month, and then to be in sort of fairly high volume production for the X in Q3 and start delivering Model X in Q3 as well. So I think as we ramp up, I think probably the demand for the new S and X will be quite high. So it's really just going to be a question of ramping supply chain and internal production processes. So probably we're going to aim to produce over 2,000 S and X per week. Perhaps if we get lucky, upwards of 2,400 or 2,500. This again is contingent on global supply chain issues, which is just a lot of factors outside of our control here, but I do think this will get solved. If you look at statement of operations here, you will see that Tesla's energy and storage business is not a large revenue contributor yet. It's still losing money every quarter. Because of this, we will focus on Tesla's core business, which is still selling Model 3 and Y vehicles. Now, according to the earnings call, Musk admitted that Tesla made a huge mistake estimating the cost of building solar roof for customers. Certain roofs are much more complex and therefore much more expensive to installing solar roof than other roofs. Right now, Tesla has to refund deposits for customers to avoid having massive losses from installing these solar roofs. This means that we should not expect Tesla's solar roof business to be a large revenue contributor anytime soon. Here is another interesting thing about Tesla you want to know. In Q1, Tesla bought 1.5 billion of Bitcoin, then sold 10% of it and made a small gain of approximately 103 million from it. Tesla's management decided to invest in Bitcoin because right now all the yields are so low and because they believe that Bitcoin has great liquidity as well as very good upside potential. So they decided to use the cash they don't need to invest in Bitcoin. But we should not treat this as one of Tesla's core businesses. Now let's talk about Tesla's long-term growth catalyst. The first long-term growth catalyst is the increasing adoption of electric vehicles and ongoing government support of electric vehicles around the world. According to this earnings slide, internal combustion vehicles, ICE vehicles, comprised 97% of cars sold globally in 2020 and 98% of Tesla trade-ins. As more OEMs join our mission by launching EVs. We believe consumer confidence in EVs continues to increase and more customers are willing to make the switch. Our Q1 order rate was the strongest in our history, and we're moving as quickly as possible to add more production capacity. Here is a very good indication to show the increasing adoption of electric vehicles. If you look at this pie chart here, you can see trade-ins are mainly from ICE competitors. Few are from other EV competitors. William Li, the founder and CEO of NIO, also shares the same view that ICE manufacturers are the main competitors. Again, Tesla delivered just below 500,000 vehicles in 2020. If you look at this here, you can see that Tesla already has the capacity to produce 1 million vehicles a year between the California and Shanghai gigafactories. In addition to Tesla's Fremont and Shanghai gigafactories, the Texas and Berlin gigafactories are on track to produce and deliver vehicles for late 2021, which will increase Tesla's production capacity further starting in late 2021, assuming that would not be delayed any further. This is from the recent earnings release. In Texas, the factory build-out continues to progress quickly, remaining on track to start production and deliveries late this year. We recently began moving equipment into the building and are in the process of commissioning them in certain areas. In Europe, build-out of Gigafactory Berlin is continuing to move forward, with production and deliveries remaining on track for late 2021. Machinery for paint, stamping, casting, etc. continues to be moved into the building. In the meantime, we will continue to increase import volumes to Europe. We are currently building Model Y capacity at Gigafactory Berlin and Gigafactory Texas, and remain on track to start production and deliveries from each location in 2021. Gigafactory Shanghai will continue to expand further over time. Tesla Semi deliveries will also begin in 2021. Now, Tesla's management also said this: we plan to grow our manufacturing capacity as quickly as possible. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. In some years, we may grow faster, which we expect to be the case in 2021. The rate of growth will depend on our equipment capacity, operational efficiency, and stability of the supply chain. Let's talk about government support for electric vehicles. According to CNBC, as a part of Joe Biden's $2 trillion infrastructure plan, Biden is also proposing to accelerate the shift to electric vehicles with a $174 billion investment in the electric vehicle market. It includes giving consumers rebates and tax incentives to buy American-made electric vehicles and establishing grant and incentive programs to build a national network of 500,000 charging stations by 2030. It will also replace 50,000 diesel transit vehicles and electrify at least 20% of yellow school buses. According to this article, China is planning to phase out conventional internal combustion engine cars by 2035. To give you more details, by 2035, 50% of the new vehicles sold in China will be electric, plug-in hybrid, or fuel cell vehicles, and the other 50% new vehicles will be the conventional hybrids that still use gasoline. But China is still planning to be carbon neutral by 2060. Now, if you look at this article here, you can see all these countries are also phasing out internal combustion engine cars by 2030 or later. What all of this means that all these government electric vehicle support will definitely benefit Tesla over the long run. I believe Tesla's second long-term growth catalyst is its decreasing cost per vehicle. Now, Tesla has many great competitive advantages, but I believe Tesla's biggest competitive advantage are its gigafactories, its manufacturing process, and it being able to bring down the cost of electric vehicles, especially Model 3 and Model Ys, to match the cost of the luxury sedans and luxury SUVs on the market right now. This is to compete with the traditional internal combustion engine cars. This is from the recent Q1 2021 earnings release. While the average selling price of our vehicles declined in Q1, our auto gross margin increased sequentially as our costs decreased even faster. Reducing the average cost of the vehicles we produce is essential to our mission. In 2017, as we began production of Model 3, our average cost per vehicle across the fleet was $84,000. Due to the launch of new products and new factories and the reduced mix of Model S and Model X, our average cost declined to sub $38,000 per vehicle in Q1. I said this earlier before, Tesla's Model 3 and Model Ys are the most important products and revenue drivers for Teslas right now. This is my opinion. Once Tesla releases its $25,000 car in a couple years, all the traditional car manufacturers that still focus on making internal combustion engine cars will have a very hard time competing because even more customers will buy Tesla's $25,000 car instead of the traditional gasoline cars. As far as I know, Tesla's manufacturing process and its gigafactories are far ahead of its competitors when it comes to manufacturing electric vehicles. Not many car manufacturers, especially the pure-play EV car manufacturers, own their factories. The battery is always the most expensive cost, so reducing the cost of the battery is the most important factor to reducing the cost of the electric vehicles. So in last year's Battery Day, Musk showed the upcoming 4680 battery with 5 times more energy, plus 16% more range and 6 times more power. He also showed his master plan that will reduce the cost per kilowatt hour by 56% through improvements in cell design, cell factory, anode materials, cathode materials, and cell vehicle integration. Now, I believe Tesla's third long-term growth catalyst is its innovations and other new products that are releasing soon. Tesla's new products include its Cybertruck, Tesla Semi, and Roadster. This means that we should expect Tesla's total vehicle deliveries will continue to increase going forward. Tesla's other products and innovations include its full self-driving subscription service, which will be released to the public soon, and its upcoming robo-taxi service. All these new subscription-based services will be new revenue sources for Tesla. If they succeed, they should improve Tesla's gross margin in the future. Tesla is much more than making electric vehicles and much more than an energy business. Elon Musk said this. I was just basically saying that although like right now people think of Tesla as a lot will think of Tesla as a car company or as an energy company, I think long term people will think of Tesla as much as an AI robotics company as we are a company or an energy company. I think we are developing one of the strongest hardware and software AI teams in the world. Certainly we appear to be able to use things with full self-driving that others cannot. Now let's talk about the risk. The first major risk is the global shortage of chips. Right now, the global shortage of semiconductor chips are affecting all the car manufacturers, including Volkswagen, Ford, Mercedes, Toyota, and Tesla. Tesla management said this. Third, as we continue to work through the instability of the global supply chain, particularly around semiconductors and port capacities. While the Tesla team, in partnership with our suppliers, did tremendous work keeping our factories running, we did experience high expedite costs in the quarter, and they were also higher than they were in Q4, with some minor interruptions to production over the course of the quarter. We believe that this landscape is improving, but it does remain difficult, and it's an evolving situation. The second risk is increasing competition. Right now, we can expect that more car manufacturers such as Volkswagen, Porsche, Audi, Mercedes, BMW, Toyota, and Ford will continue to make more electric vehicles to compete with Tesla. Also, there's the rumor that Apple may release its upcoming Apple car in the next couple years to compete with Tesla. Right now, Tesla's current Model 3 and Model Ys are far ahead of other competitors. Personally, I believe that Tesla has the first mover advantage. I also believe that Tesla's manufacturing process, especially its battery tech and its gigafactories, are also far ahead of other competitors. The third risk is this. Right now, Tesla still has very low operating margin, around 5.7%, which is very common for a car manufacturing company. Of course, I said this earlier before, Tesla is much more than an electric vehicle company and a battery company. Once Tesla releases its full self-driving subscription service and other subscription services, I believe that all these new services, especially the software subscription-based services, should improve Tesla's gross margin and operating margin going forward. But as of now, Tesla is still in the growth stage. Tesla still have high capital expenditure each year, or CAPEX. Tesla still needs to reinvest most of its capital into the business, so we should not expect Tesla to have high operating margin anytime soon. Now let's talk about Tesla's fair intrinsic value, so we'll know whether Tesla is currently overvalued, fairly valued, or undervalued right now. First, I define Tesla's intrinsic value as its future cash flow in its lifetime discounted to the present day. I want to show you my intrinsic value calculator here. Here are the key assumptions I'm making. I'm using a discount rate of 11%. This is higher than the 7.2% WACC discount rate from Finbox.com. I also use a discount rate between 10% and 15%. If a company has high risk, then I will use a higher discount rate. The second key assumption is that we're using a cash flow compound annual growth rate between 40% and 60% each year. Now, Now, Tesla's management said this in the recent earnings call. As we look forward, our plans remain unchanged for long-term growth of 50% annually, and we believe we're on track to exceed that this year as we guided to last quarter. The third key assumption is that to calculate the terminal value at the end of year 5, we're using the average of the perpetual growth model and the exit multiple model to calculate or to estimate the terminal value at the end of year 5. We're only projecting 5 years of free cash flow growth. Now, in my opinion, it's very hard to project Tesla's free cash flow growth for the next 10 years. So we just focus on projecting Tesla's free cash flow for the next 5 years, which I believe is more realistic. Let's go over each of these case scenarios. There are 3 case scenarios. The worst case scenario with a compound annual growth rate of 40%. The normal case scenario with a compound annual growth rate of 50%, and the best case scenario with a compound annual growth rate of 60% each year. Based on the worst case scenario, we're using the cash flow compound annual growth rate CAGR of 40% each year. If we project Tesla's cash flow to the next 5 years and then discount it to the present day, then Tesla's intrinsic value as a whole company should be around $471 billion, comparing to Tesla's current market cap of $683 billion as of April 30th, 2021. And if we divide the intrinsic value by the shares outstanding, then Tesla's intrinsic value per share should be around $489 per share, comparing with its current stock price of $709 per share as of April 30th, 2021. Under the normal case scenario, we're using a cash flow compound annual growth rate CAGR of 50% each year. If we project Tesla's cash flow to the next 5 years and then discount it to the present day, Tesla's fair intrinsic value as a whole company should be around $661 billion, compared with its $683 billion market cap as of April 30th, 2021. And if we divide this by the shares outstanding, Tesla's intrinsic value per share should be around $686 per share, compared with its current stock price of $709 per share as of April 30th, 2021. Under the best case scenario, we're using a compound annual growth rate of 60% each year over the next 5 years. If we project Tesla's free cash flow to the next 5 years and then discount it to the present day, Tesla's current intrinsic value should be around $908 billion as a whole company, compared with its current market cap of $683 billion market cap as of April 30th, 2021. If we divide the intrinsic value as a whole company by the shares outstanding, Tesla's intrinsic value per share should be around $942 per share, comparing with its current stock price of $709 per share as of April 30th, 2021. Personally, I believe the normal case scenario with a compound annual growth rate of 50% is much more realistic. Even Tesla's management expects that Tesla will be able to achieve a compound annual growth rate of 50% each year over the next few years. So am I buying Tesla stock? Yes, I am planning to buy more Tesla shares if it drops well below its intrinsic value. Personally, I want a much greater margin of safety in order to reduce risk and to buy Tesla shares when I believe it's undervalued. Now, I bought Tesla shares several times in the past 12 months, representing about 8.4% of my stock portfolio right now, because I like Tesla's dominant position in the EV market. I also like Tesla's current competitive advantage and its long-term growth prospects I mentioned earlier in this video. Based on my estimate, I believe Tesla's fair intrinsic value is around $661 billion as a whole company, or $686 per share. Now, all these estimates are only my opinions based on my research and based on my analysis. Make sure you always do your own research and always do your extra due diligence first. If you like this video, hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and commentary videos every week that will help you become a great investor. This is Victor from the Intelligent Investor channel. Thank you for watching, and I will see you in my next video.